Bloomberg Audio Studios.
Podcasts, radio, news.
I'm Stephen Carroll, and this is Here's Why, where we take one news story and explain it in just a few minutes with our experts here at Bloomberg.
The tech giants disclosed huge AI spending plans in their latest earnings report.
Alphabet is kicking off a 7-part bond sale, adding to a borrowing spree by companies at the forefront of the AI investment boom.
The idea of a 100-year bond for one of these hyperscalers is crazy to me because we don't even know what the next 3 years is going to look like, let alone 100 years.
You might be bracing for $400 billion of investment-grade debt coming to finance AI.
The AI spending spree is gaining speed, and it's coming with massive borrowing. Bloomberg Intelligence estimates that the biggest tech firms will spend more than $4 trillion by 2030 in their efforts to dominate the technology. To fund it, they're spending cash and raising huge amounts of money in debt markets. Here's why AI ambitions are fueling a borrowing boom. Our Markets Live strategist, Skylar Montgomery Koning, joins us now for more. Skylar, first of all, can you put this scale of borrowing in context for us? Have we seen anything like this before?
I mean, the short answer is no. We haven't seen this kind of spending as well as borrowing before, at least not in my lifetime. Now, the slightly longer answer is that technological revelations or revolutions require investment, and investment needs to be financed. But what makes this AI cycle different is both the scale and the financing mix. Now, the spending is exceptionally large, and it's increasingly debt finance. From what I've read, more money has already been put into this technology boom than telecom networks in the 1990s or anything that's come in recent decades, but less than, say, the railroads in the 1840s, which is quite a while ago, and was one of the largest infrastructure booms in economic history. What makes AI unique is that it combines a kind of breadth and capital intensity. So the technology can be deployed across almost every sector of the economy, but it's also capital intensive. It needs long-lived, power-intensive assets. To give you some numbers on debt specifically, the Dallas Fed thinks that $300 billion of investment-grade or IG issuance related to the AI build-out is a reasonable estimate for this year. Now, that's a very big shift for companies that have historically been relatively capex light and cash flow funded. It's also significantly for the credit market itself. That $300 billion value is roughly 17% of total US IG issuance in 2025, and that debt is only being added for AI. So we've seen technology booms before, but the combination of scale and the high degree of debt financing makes this cycle stand out.
Yeah, it's certainly remarkable in so many aspects. Can you just remind us of what the tech companies are planning on spending all this money on?
Yeah, some of it's continued development, as you would expect. So that's stuff like improving large language models, training more advanced systems, building chips. But the majority of the spending is far more physical than I think people realize. It isn't just software, it's kind of industrial scale infrastructure. Now, companies are building enormous data centers that are the size of kind of multiple football fields. In other words, AI is becoming an energy and infrastructure story that has real world spillovers. Now, data centers consume large amount of electricity and land, which puts pressure on local grids and resources. It also drives demand for construction and commodities. So this isn't a typical tech investment cycle, and that's why the borrowing is so large. These are long-lived, capital-intensive assets, not kind of incremental software tweaks.
And is that also why we're seeing these companies, which are very rich, borrowing rather than using cash or issuing shares?
Again, here, there's kind of a short answer and a long answer. The short answer is they can. There's clearly strong demand for this debt. Investors want high quality yield, and large tech issuers are seen as very safe borrowers. The long answer is more about capital structure. So these companies are coming from a position of strength. They have robust balance sheets and strong cash flows, so it makes sense to introduce more debt into the mix. For corporates, debt financing is actually cheaper than equity financing. So even though we've had government bond yields rise in recent years, high-grade tech companies can borrow at relatively tight spreads, so that lowers their weighted average cost of capital. There's also a flexibility element development in that instruments like convertible bonds that some of these companies are issuing gives them the option to convert debt to equity in the future. And this is also just a very large investment cycle. So funding it with debt rather than equities means you aren't diluting shareholders or running down cash to the point that you need to worry about liquidity. So ultimately, it's about capital optimization. When debt is cheaper than equity and your balance sheet is healthy, it can make sense to borrow to fund a long-term growth opportunity.
Okay, and even within the borrowing, there's loads of firsts here too. Alphabet's issuing sterling and Swiss franc debt, and even a 100-year note. What does it tell us about the investor appetite for this kind of debt?
Well, I just want to say first that it's wild, but also that it tells you that there's a lot of demand for this debt on a global scale, and that companies are trying to capture a wide investor base. The 100-year bond in particular is wild. Investors are willing to look at...
we don't know where this technology is going to be in 10 minutes, it feels like.
Exactly. And investors are essentially saying that they're willing to lock up capital for what is likely to be longer than their lifetimes at relatively modest spreads because they believe in the durability and the growth potential of these companies. Now, the fact that this issuance is happening in foreign currencies, you mentioned sterling and the Swiss franc, that also highlights the breadth of demand. So it's not just U.S. investors, it's global. It also speaks to the scarcity in that there isn't a huge supply of high-grade credit with structural growth exposure. And with the tech trade already crowded in equity markets, some investors are clearly looking for alternative ways to gain exposure, and credit provides a different entry point into the same kind of structural trade.
What does all of this deluge of debt mean for the credit markets more broadly?
This is the interesting part to me. Whenever you get this structural shift within markets on such a large scale, there are bound to be unintended spillovers. For credit markets, the surge in AI-related issuance likely has a couple. Mostly it's around diversification. So credit is often held because it sits between equities and government bonds. It offers income and some growth exposure, but with lower volatility than stocks. However, as AI-related issuance increases, that balance shifts. So historically, credit indices have had relatively low exposure to tax because these companies didn't need to borrow much. But now, with heavy AI capex, large tech firms are issuing substantial amounts of debt, and that increases their weight in credit indices. So it makes the market more concentrated, and it incrementally makes it more similar to equity benchmarks. Now, that's especially true if their issuance crowds out other sectors from selling bonds. At the same time, spreads are already very tight, so the risk buffer that credit provides over government bonds is already limited, and that means returns become more dependent on moves in underlying rates rather than spread compression. And that's particularly important because much of this tech issuance is long duration. What I mean by duration, it's really just a measure of how sensitive a bond's price is to interest rates, and is related to maturity, and that, very simply, a longer maturity typically means a higher duration. And the U.S. investment grade index already has a duration of around 7 years, but the issuance that we're seeing out of tech is 40-year, 100-year bonds, and that will push the average duration of the index higher, and that means you get an increased sensitivity to interest rates and increased volatility of these credit indices. So taken together, credit could become more equity-like in its concentration and more rate-sensitive in its behavior, which chips away at the diversification benefits investors typically expect from it. Now, as I said earlier, with any major market shift, there are unintended consequences. These are the ones we can see, but there are also others that will likely emerge too.
Yeah, it's a fascinating rewiring of these markets as well. Dare I ask the question, what happens if this all goes wrong? What if AI doesn't meet the big expectations there are for it?
The main risk is simple. It's just that the return on investment doesn't justify the scale of spending. So, in other words, it's just that the investment is unprofitable. Now, at the market level, concentration amplifies that risk. So, tech already represents a large share of equity indices. And as I said, it's becoming a larger share of credit indices as well. That means investors, often passively, are increasingly dependent on a relatively small group of companies continuing to execute. If those companies disappoint, the repercussions aren't as contained because of their index weights. Weakness in the sector weighs disproportionately on broader equity and credit markets. And with credit markets in particular more involved now, there's also a financing angle where if returns disappoint, spreads widen, and that means funding costs widen or rise for most indices or corporates, particularly for weaker or second-tier players. Now, that adds a vulnerability to the broader financial system. Now, the good news is that the largest issuers are starting from strong balance sheets and substantial cash flows. And generally, with periods of technological advancement, you get higher productivity and return on capital. So on aggregate, markets do well. But under the surface, you need to be aware that individual companies, there are also clear winners and losers there.
Okay, Skylar, thanks so much for joining us. Skylar Montgomery Koning there, our Markets Live strategist. For more explanations like this from our team of 3,000 journalists and analysts around the world, go to bloomberg.com/explainers. I'm Stephen Carroll. This is Here's Why. I'll be back next week with more. Thanks for listening.